At this time of the year, it's customary to look at the year that's just passed and make some forecasts for the year ahead. Hi, I'm Michael Yardney, and 2011 will be remembered as the year the property market slumped. It didn't crash like many property pessimists predicted, but it stalled in some areas, it dropped a little in other areas, and prices fell significantly in a few spots. Ongoing economic uncertainty, the worry of rising interest rates for much of the year, decreasing affordability, and political uncertainty were a volatile mix that stalled our property markets. In a moment I want to go through a bit about what happened for the year and to give you some hints, some lessons that I've learned to help you into 2012 to make that a great year for you. But before I do, I'd like to mention to you one of my great books that I'd love you to read called Thriving, Not Just Surviving in Changing Times. And why I want you to get it, why I want you to read it is because 2012 will be a volatile year. We are going to be going through changing times. And top author and trainer Brian Tracy said this is the roadmap that you need to see you through troubled times. This was a great book he recommended, and it's one I'd recommend to you to get as well. So click on the link below and go to our bookshop and get yourself a copy of Thriving, Not Just Surviving in Changing Times, so you can make the most of the changing times in 2012. So as I started to say, the property market didn't crash like some of the property pessimists suggested. And you know what? Everything points to a much better year ahead. What the overall figures for the year didn't show is how fragmented the markets are. The upper end of our property markets in particular fell. Some say 5%. I think they've dropped more than 10 to 15% in some areas. But do you know that homes located in 80% of Sydney suburbs actually had capital gains of around 1% in 2011? It's only the most expensive suburbs in the more affluent areas which have been the hardest hit and suffered substantial price declines, and also on the Gold Coast. The markets are similar right across Australia. For example, the cheapest suburbs have actually recorded only small capital losses, while the dearest suburbs, the dearest markets, fell, as I said, often up to 10 to 15%. What I call investment grade properties, the middle price range is say between $450,000 and $950,000 in prime locations and with an element of scarcity. They're still selling well to owner-occupiers and to investors. There's clearly much less interest from owner-occupiers and investors than there was before. However, B and C class properties, they're not selling well at all. Some have dropped in value by over 10%, and some can't be given away. Well, that's not really as bad as that, but there's some very steep discounts have to be given for people to buy them. Anyway, all the indicators suggest that the slowdown will continue until well into the first half of 2012, despite a couple of interest rate drops. You see, the number of the properties on the market are high. Properties are remaining on the market for sale longer than before, and many buyers are still a bit nervous about making a decision. So let's look at some property lessons to help you through 2012. Probably the most important lesson we can learn from all of this is never to get too carried away when the market's booming or too disenchanted when the market slumps. Letting your emotions drive your investments is a surefire way to disaster. Okay, lesson number one. Booms never last forever. During a boom, everyone's optimistic. They expect good times to last forever, just as we lose our confidence during a downturn. Our property markets behave cyclically, and each boom sets us up for the next downturn, just as each downturn paves the way for the next boom. Let's face it, while the news is much less positive today, we know that over the next few years, the flatter market conditions will be followed by another property boom, and then another downturn. And over the next decade, we'll have another recession, if we have one every 7 to 10 years, and we're most likely going to have another depression one day. Now, I don't know when it is, but the lesson is to get prepared for the next phase of the property cycle. During the last cycle, most investors didn't really have their downsides covered or their upsides maximised. My lesson number 2 for you today is beware of doomsayers. For long as I've been investing, that's over 37 years, I remember hearing people with excuses why property prices are going to stop rising, or even worse, why property values will plummet. However, in that time, well-located properties have doubled in value every 8 to 10 years. I've found that fear is a very powerful emotion and one that the media uses to grab our attention. Sadly, some people miss out on the opportunity to develop their own financial independence because they listen to the messages of those who want to deflate the financial dreams of their fellow Australians. Lesson number 3 for you is follow a system. You see, smart investors follow a system to take the emotion out of their decisions and to ensure they don't speculate. Now, it could be boring, but it's profitable. Let's be honest, almost anyone can make money during a property boom because the market covers up most mistakes. But many investors without a system found themselves in financial trouble when the market turned. Warren Buffett said it succinctly, you only find out who's swimming naked when the tide goes out. In other words, if you aren't following a system, one that works in all market conditions, you're going to be caught naked when the market changes. So if you prefer to have consistent profits at reduced risks, follow a proven system. Make your investments boring so the rest of your life can be exciting. Lesson number 4, get rich quick means get rich poor. Lesson number 4, get rich quick usually means get poor quick. Real estate's a long-term investment, yet some investors chase, I guess what I'd call the fast money. You've probably met people like that. They look for the deal that's going to make them fabulously rich. And when you see them next year, yeah, they're still usually looking for a deal because they're no better off financially. They're still talking about that next deal, that one that's going to make them rich. They're often influenced by the latest get-rich-quick artist with a great story about how you can join them and become stupendously wealthy. These stories can be very compelling, even hard to resist at times. They often pander to the wishes of people who'd like to give up their day jobs to get involved in property full-time. But in reality, it takes most people many years to accumulate sufficient assets to do this. Patience is an investment virtue. Warren Buffett said it right when he explained it. Wealth is the transfer of money from the impatient to the patient. My last lesson, number 5, is it's about property. Now, what do I mean by that? See, you're in the business of the property investment business. Yet during the last boom, I saw many investors forget the age-old property fundamental of buying the best property they could afford in a proven location. Instead, they got sidetracked by glamorous finance or tax strategies, and some lost out. Smart investors are doing it differently. They make educated investment decisions based on research and buy a property below its intrinsic value in an area that's had above long-term capital growth, and they find properties to which they can add value. They can manufacture some extra capital growth. These are just 5 of the many lessons that I learned from my previous experience in downturns. We know that a few years ago the pendulum swung too far in some regions and the markets are catching their breath. In some areas property prices are flat, and in others they've fallen, and in others they're going to continue to languish for a while. We also know that if history repeats itself, some markets will swing too far in the negative, driven by fear. If you learn these lessons from previous cycles, the roller coaster ride won't be as dramatic this time because you won't let your emotions drive your investment decisions. Remember that both fear and greed will drive you down the wrong path. Now, this is my last major property commentary for the year. But with so much happening in the property nowadays, I'm going to keep you updated with short daily blogs. So just click on the link below, which gets you to Michael's blog, or at the one at the top actually it says here, if you're at the property update page, Michael's blog. And it's a different subscription to my fortnightly newsletter. It gives you my short daily updates. I'd like to do that for you over the holiday period. Pam is on the other side of this camera, and myself and the whole team at Metropole wish you a fantastic festive season and a great 2012.